Hey everybody, thanks for tuning in. I'm Mike Mansfield. I've got Owen Hill here reporting to us from lovely Flower Mound, Dallas, Texas. Owen, it looks sunny outside. You guys have had a heck of a lot of weather lately. How you doing, man?
Yeah, we're good out here. I mean, we just had an eventful weekend. A pretty crazy thunderstorm blew in. We've got some tornadoes, not near us, but maybe a little more west and east of us, and then some stuff going on up north. So today is sunny. Yesterday was nice and beautiful. We've got weather blowing back in, I guess, towards the
Yeah.
halfway mark of the week. But all in all, we're happy and safe and enjoying the sun while we have it.
Good. Well, obviously a lot going on. We wanted to get a video out to everybody this week. Things have been insane for the last week. Obviously, we have a war breaking out in the Middle East. We have a lot of hyperbolic issues with stocks and energy, a lot of moving parts. To be fair, the trajectory of it is very unknown at the moment. Some of the things that we thought would be feeling resolved quicker, like moving energy through the Strait of Hormuz and all those things, are all still stagnated at the moment. But as I was reflecting on this over the last number of days and doing my own little research, Owen over the weekend sent me kind of a fascinating chart. I'm going to pop it on here because I think it tells a very interesting story that it's
Yeah.
easy to lose perspective of. So why don't you walk us through this, Owen?
Yeah, so I apologize for sending this over the weekend, but it came across my feed and I figured it'd be cool to make a video on it because it does. Like you said, it gives perspective. So, what this chart is showing is conflicts, major conflicts and wars of the last, call it 100 years. And so, I think the trend is this, and it's pretty visual. Over the last 100 years, the market's gone up, but more importantly, what we're experiencing and what we're going through right now is it's not a unique thing. Um, we've seen this happen over, I think on this specific chart has 28 of the last major conflicts or wars that we've experienced. And so it can be an emotional thing, it can be a frightening thing. There's a lot of volatility, there's a lot of unknown, and there's a lot of worry that coincides with this. But if we can hold on to the long term perspective of, look, this has happened before, we've seen this play out over the long run, the market goes up, things rebound. In fact, here at the Lynn Group, we use portfolios that are baking in the idea that certain sectors, areas of the market aren't going to do well. And so, you know, we are looking for winners. And so, more specifically, this sector, energy or the dividend paying stocks, those areas of the market are actually doing really well this year. And so, if we
Right.
can hold on to the idea that, again, this is just a moment in time and things are going to end up well and over the long run continue to trend upward, I think it'll be easier for us to just move through this moment of unknown.
Yeah, it's kind of a crazy chart. As you were talking, I was counting. So there are 28 bubbles on here, and that's not
Yeah.
including the current one. And so
Right.
in 100 years, that's 29 occurrences. That's
Yeah.
basically we're averaging one every three and a
Yeah.
half ish years or something like that, which
Yep.
is in a way terrifying, but also shocking to
Yeah.
maybe how unfortunately ununique what happening is
Yeah.
happening.
Yeah. Exactly.
Even to your point, when you look at the far right, I look at the Syrian war, the Iraqi war, Russia, Ukraine. It's hard to see the chart past the Israel one,
Yeah.
but
You know.
but even in those time periods, you don't even have drawdowns in the market. The market
Yeah.
just keeps trending up,
Yeah.
and I think to the point you were making is so much that has to go to what's really going on there. Subsets of markets do really well in unfortunate crisis periods. You said energy, dividend stocks, precious metals, all the things that people choose to renege back to. Even traditionally going into bonds is obviously a
Right.
good place to get a
Right.
positive return as people flood into that stuff. But the question is why? What is going on right now that's creating the upheaval? What I pulled up is this is just the oil chart on the current futures for April. And what it shows is the year to date. And so if you're sitting here looking at this chart, what do you see? You see that, it looks like the market just went, is moving sideways and then it just goes straight up, right? We're averaging kind of this 60 some odd bucks a barrel. And boom, all of a sudden now we're at basically $100 a barrel. But what's interesting is time is always a funny perspective. Like it's easy to put a short chart in there and be like, everything is horrible. But here, if I go to the 5-year chart, for example, we can see back in 2022, oil peaked out at 120 bucks a barrel. Now, a lot of this had to do with the Ukraine-Russian war going on. It had to do with also 2022 is where we had the true hyperinflation hitting 9%, depending on how you measure it. And so we're not even back there. And even if you looked at this 5-year chart and you took off that peak back in 2022 and you just said, well, what's even like kind of an average price anyways? Maybe it's somewhere around 90 bucks a barrel when you really, or 85 bucks a barrel, something like that, where obviously it was very low last year, but it's been kind of on the high side. It's just on the high side of normal at the moment. If I zoom out, at least as far as this thing goes, which is what, about 50 years, you see basically since the early 2000s, oil's been high, right? It's just been hanging out high. And where the price is, yes, it's certainly elevated looking, but in the last 20 years, it's just kind of at the high side of normal. Now, I think there's a lot of opportunities for oil to go back down because the supply chain system has changed dramatically in the last 20 years. The access to energy has changed dramatically. But to that point, we have this linchpin, right? I don't even have to tell you this. It's all over the news. Everyone's showing the maritime map thing. Here, I'll pull it up while we're talking. Look at this. We can adapt live time while we're talking to you. But really what happens is they talk about, the energy that flows through the Strait of Hormuz, which is this area right in the middle. And so where there's really no ships, whereas if I zoom out, there's lots of ships everywhere. Just that weird little linchpin right in the middle of that, that nobody's pushing through at the moment. This is where 20% of the world's oil flows through, and something like 30% of the world's liquefied natural gas. So this is a very probably temporary issue. Obviously, the government wants to work very quickly at trying to get the ships to move through here, and I imagine as that happens, this will inherently soften. It will inherently pull back. But we have such a teeter-totter that as oil goes up, the stocks are going straight down. Now, perhaps why is the question, right? And so the main reason for why is it's about economics, which chart do I want to show? So if let me go on a side tangent here real quick. Last week, we got a jobs report. Remember, we're all forgetting about like the economic news and all of the other things. We're so focused on the conflict. But we had a horrible jobs report last week. Holy cow. They were estimating 50,000 jobs were going to be created in February, and it fell. It was down 92,000. I mean, that's a massive swing of jobs. We're off 140,000 from our projections. Yep. So remember, the Federal Reserve has a dual mandate. Keep the labor market under control prices. And so we have a weird issue. The issue is energy prices are going up, right? We were just talking about that. Here's our energy prices. They're trending up. Here, we'll go to the year-to-date chart so it feels more dramatic. They're trending up. Energy governs all pricing, right? The price of the tomato at the market is because of the price of a barrel of oil. And so now the concern is, well, wait a second. How can the Fed cut? Is the Fed going to have to raise interest rates to deal with potentially inflation risks associated with high energy costs? But we also have a declining labor market. So unfortunately, this now brings up the word of stagflation. Are we entering some kind of stag environment that could be very problematic? And so it's amazing, though, when you look at the old Federal Reserve. I just went up to the CME rate watch tool. What do we got? 97% chance they're not cutting this month. That means they're not cutting. April, 90%. Yeah, they're not cutting in April at the moment. June, a little more of a probability. July, a little more. So maybe by June or July, they're thinking there's a cut. But also, let's be fair. In May, we get a new Federal Reserve president. So that's a part of it. But, they can make the justification, hey, we're cutting because the labor market's falling apart. They could also make the justification, hey, we're raising rates because we're concerned that the energy prices are going to force inflation back up. Right. So what a fiasco we live in at the moment. Going back to this jobs report, though, it was a little surprising. I know you dig into these pretty well, Owen. What things are driving this mess?
Yeah, so when you actually look at the statistics of it, the numbers baked into everything, you could chalk up about 10% of the decline in the jobs falling based off of or contributing towards AI. So AI has been a big factor for good and the evil, right? I think productivity has increased, but also we're seeing the negative
Yeah,
effects
it's tough.
in the labor market. And then also, if you go into the report, you read a little more into it. They talk about weather. You kind of sound silly, but if you go back a couple months, you realize that, yeah, we've had some pretty substantial cycles of weather that have actually slowed down the labor market. And so, historically speaking, weather is a factor that goes into how our labor market performs. So you put two of those together, and yeah, you're going to have a pretty bad number.
No, yeah, it's a good point though. I mean, in February we had those insane. I mean, you guys got frozen out in
Yeah,
Dallas,
completely frozen over.
but the
Couldn't leave your
East
driveway.
Coast, the Midwest, yeah. I
Yep.
mean, that probably brings up a very strong point. But almost to the point of the Federal Reserve, are they looking at these things as, remember that scammy word they like, transitory? Are these transitory issues?
Yeah.
They're super temporary, and everything's going to right itself and magically be better. I don't know.
Right.
If once again, if all of a sudden the conflict in the Middle East winds down, if all of the sudden the strait opens up, if all of the sudden the sun's just out everywhere and people start hiring, things can turn around pretty quickly. But from a
Right.
stock market standpoint, I put these little squares on the chart here. You can kind of see here, here's one on the right side. This is just showing kind of year to date the pullback. So in February, the S&P hit 7,000. It's just shy of 6,800 at the moment. So it's definitely come down. But the reason I wanted to highlight this on here is I come back to last year, this chart, this square right here. Does anyone remember good old 2025? We just had it. Between February and April, the general stock market fell 20% dealing with the tariff liberation stuff. And so it's ironic that we're kind of retracing that a little bit. I mean, these are two fundamentally different reasons for market volatility. But the reality is, yes, the market has pulled back. The S&P year to date is down 2%. Once again, coming off of these great years last year, even with this chaotic mess right in the middle of the year, the S&P still ended up 15%. So the reality is the market is in a very controlled place at the moment. Earnings are very strong. We did an earnings report a week or two ago for you guys. Earnings have come in very good. We have deregulation as a tailwind to the stock market. So far, the projection of the refunds, tax refunds coming out are very positive for what we thought they might be. That helps quell a lot of things. Number one, that helps quell gas prices for individuals if they're getting larger refunds. But either way, the chaos continues. Obviously, our opinion is it's hard to make decisions when you don't have all of the information. We're not sure what's going to happen with the conflict, but we do know a couple of things. We do know that the administration is highly motivated to turn this into a win, highly motivated to get energy prices moving again.
Yep.
And so, it seems statistically likely that perhaps in the next week or so, we should get at least a very positive understanding of what's going on with the energy stuff. So with that, Owen, always appreciate you hopping on with me. I know that by the time you're recording these, it's already, I don't know, bedtime probably in Texas.
Yeah, I got to get back in bed.
So
No, I
in
appreciate
any
it.
case, we appreciate all of our viewers, all of our listeners, and certainly appreciate all your feedback. We hope you guys have a great day. We'll talk to you soon.